All right, so let's dive into these market moves from November 27th, 2024. We're going to use the closing market report from Market Deep Dive to guide us through this.
Sounds good, yeah. There's a lot to unpack in this report.
Yeah, so right off the bat, there's something that I think is really interesting. More stocks closed higher than lower today,
Uh,
but the major indexes like the S&P 500 still ended up in the red.
yeah.
How does that even work?
Well, it really kind of highlights a key dynamic that's happening right now, and that's that the influence of those mega cap companies, particularly the ones in tech.
Okay.
We're seeing a rotation out of those companies, and that shift can really drag down the entire index, even if smaller companies are performing well.
So it's kind of like a tug of war, where those mega caps are pulling the whole index down even though there's positive momentum elsewhere.
Exactly.
And I guess that makes sense, especially if you're heavily invested in index funds that track the S&P 500.
Right.
You could actually be seeing losses, even if most of the companies in the index are doing all right.
Yeah. And this is where it becomes really important to look beyond the headlines and understand what's driving these underlying trends.
Okay, so we've got these moody mega caps weighing things down. But what about the actual economic news?
Right.
The report mentions the PCE data.
Yeah.
That's a key measure of inflation, right?
Yes. Core PCE, and that excludes food and energy prices, came in at 2.8% for the year,
Okay.
which is in line with expectations, but it's still a bit higher than the Fed's 2% target.
And the market's reaction to this was kind of a shoulder shrug. I was half expecting a bigger move, considering inflation's still a hot topic these days.
Yeah, I think a lot of people were. But here's the interesting thing. While stocks dipped slightly, the bond market actually reacted in the opposite direction.
Oh, really?
Yeah, Treasury yields went down,
Yeah.
and the probability of a rate cut next month actually went up.
So the bond market seems to be betting that inflation isn't as big of a worry as the stock market's making it out to be.
That's one interpretation. It kind of suggests that PCE wasn't the main driver of the market sentiment today.
Okay.
There's something else at play here, something that's making investors a bit more cautious.
So we've got mega caps acting up, inflation data sending mixed signals, and a mysterious force lurking in the shadows. This is getting interesting. But before we try to unmask that mysterious force, I want to dig into this sector rotation the report keeps mentioning. It seems like a pretty big deal.
It is. It's essentially a shift in where investors are putting their money. Right now, we're seeing a move away from those high-growth tech stocks that have dominated the market for the past few years and into sectors that are more tied to the overall economy, like industrials, financials, consumer discretionary.
The ones that do well when the economy is growing.
We call those cyclical sectors because their performance tends to cycle along with the ups and downs of the economy.
Okay.
And the report highlights some interesting evidence of this rotation. They compare the S&P 500 SPX with the S&P 500 Equal Weight Index, which is SPXEW.
Okay, so SPX is the standard index.
Right.
But what's so special about SPXEW?
SPXEW gives equal weight to every company in the index, regardless of size.
Okay.
So unlike the regular S&P 500, where mega caps have a big influence, the SPXEW gives us a more balanced picture of how the broader market's doing.
Gotcha. So what's the tail of the tape between these two indexes?
Well, over the past 5 days, the SPXEW is up almost 3%, while the SPX is up less than 1%.
Wow, that's a pretty big difference. So it seems like those smaller companies, many of which are in those cyclical sectors, are really driving the gains right now. But what's causing this shift? Is it just a natural ebb and flow of the market, or is there something else at play? The report mentioned a Trump victory tailwind. I'll admit I'm not quite seeing the connection there.
So think back to the policies Trump championed: deregulation, tax cuts, things that were generally seen as beneficial to businesses, especially those in cyclical sectors.
So when he won, investors started putting money into those sectors, betting they would outperform. And that optimism, that tailwind, is still playing a role in the rotation we're seeing today.
It could be. It's a good example of how seemingly unrelated events can have a real impact on market dynamics.
Yeah, that's wild. But okay, let's zoom in a bit and look at some of the companies that made headlines today. The report mentions Dell taking a pretty big hit.
Yeah, their stock plunged over 12% after missing on both revenue and guidance.
Ouch, that's gotta hurt. But they also mentioned strong demand for AI-related tech, right? So is this just a Dell-specific problem, or could it be a sign of trouble in the broader tech sector?
It's a crucial question, and one that analysts are grappling with right now. It's tough to tell from just one company's earnings, but it's definitely something to keep an eye on.
All right, noted. What about Workday? They seem to be doing all right, at least on the surface. The report says they beat earnings estimates.
They did, but their stock still dipped a bit. And that's a great example of how positive earnings aren't always enough to satisfy the market.
So what spooked investors this time?
Their forecast for future subscription growth was a bit weaker than analysts had hoped for. And, in today's market, where growth is king, that can overshadow a solid earnings beat.
It's like getting an A when you were aiming for an A+. Technically good, but still a bit of a letdown. Okay, and last on our earnings roundup is Nordstrom.
Yeah.
They also beat expectations, but their stock took a hit. What's the story there?
Their guidance was pretty conservative. Basically, they're saying they're not overly optimistic about the coming months.
Yeah, I mean, with all the uncertainty out there, it's understandable that people might be holding back on spending. I guess that's especially true for a company like Nordstrom, which sells a lot of discretionary items. So maybe this is a sign that the retail sector as a whole is bracing for some headwinds.
It's a valid point. We'll have to see how retail earnings look over the next few weeks.
Right, so we've covered individual companies, but the report also flags some potential trouble brewing in the semiconductor world.
Yeah, the SOX index, which tracks semiconductor companies, was down over 1.5% today. And it's actually been underperforming compared to the broader tech sector for a while now.
And the report attributes that to ongoing tariff concerns, specifically those targeting China. But why are semiconductors getting hit harder than other tech companies?
It all comes down to the nature of the business. Semiconductors are a global product.
Okay.
Different components are manufactured in various countries, assembled in others, and then shipped all over the world.
So it's a very intricate supply chain.
Precisely. And tariffs disrupt these delicate networks. They can drive up costs, create uncertainty, and make it harder for companies to plan ahead. So the semiconductor industry, which relies heavily on these global flows of goods and materials, is very sensitive to these trade tensions.
So basically any disruption to that global trade machine can throw a wrench into the whole semiconductor industry.
Right.
And judging by the SOX index, those wrenches are flying. But okay, enough doom and gloom for now. Let's shift gears and look at the bigger market picture. The report mentioned some interesting technical signals.
Right. They highlight that the S&P 500 closing below 6,000 could be a sign that we're heading into a period of consolidation.
Consolidation, so basically like a sideways movement.
Yeah, where the market takes a breather after all the volatility.
Okay.
But there's a catch. The report also points out that trading volume is expected to be pretty low tomorrow.
Oh, right, because it's Black Friday.
The day after Thanksgiving.
Everyone's still stuffed from their turkey dinners.
Exactly. And that low volume can make it a little harder to get a clear picture of what's going on.
Yeah, makes sense.
So, those short-term market movements might not be as meaningful. We might have to wait till next week to see what happens.
So a wait-and-see situation for now. But even with low volume, Friday isn't completely quiet on the data front. The report mentioned some key economic data coming out overseas.
Yeah, we've got a bunch of data coming out of Japan. Tokyo CPI, retail sales, jobless numbers, and even a Bank of Japan rate decision. And from China, we'll be getting their manufacturing PMI.
Wow, so a lot to digest. And I have a feeling it's all interconnected. The report even mentioned something about the yen carry trade, which sounds interesting.
It's a pretty straightforward concept. Imagine you're an investor looking for the best return on your money. You notice that interest rates in Japan are really low, so you borrow money there.
Right.
Then you take that borrowed money and invest it in assets with higher returns, like in the U.S.
This is essentially profiting from the difference in interest rates between the two countries.
Exactly. And that's the basic idea behind the yen carry trade. It's a popular strategy, and it's one of the reasons why economic data from Japan can affect markets all over the world.
Okay, I'm starting to see the connections here. But how does all of this tie back to the data that's coming out Friday?
Well, if that data suggests that Japan's economy is getting stronger, it could lead to the Bank of Japan raising interest rates sooner than expected.
And if Japanese interest rates go up, that makes the yen carry trade less profitable.
Right.
So investors might start pulling their money out of the U.S. and other markets.
Exactly. It's like a chain reaction. And that's why these economic releases from Japan can actually have an impact on your portfolio, even if you're not directly invested in Japanese assets.
Like a giant financial spiderweb with everything interconnected.
Yeah.
This is making my head spin a little bit in a good way. I'm starting to grasp how global these market dynamics are.
And that's what makes it so fascinating, right? But before we wrap up, there's one last point I want to highlight from the report. They mentioned that core inflation in developed markets has stopped moderating.
So basically, inflation isn't coming down as fast as we might have hoped.
Yeah, and this raises a big question for central banks around the world, not just the Fed. If inflation is stickier than expected, are they going to have to keep interest rates higher for longer? What's that going to mean for global economic growth? How will it impact investment strategies?
Those are some pretty big questions.
Yeah.
It feels like we went from decoding market movements to pondering the fate of the global economy.
It's all connected, and that's why staying informed and understanding those broader trends is so important.
Okay, so let's try to distill all of this down into some key takeaways. We started with the fact that more stocks were up than down, but the indexes still closed in the red. And that was due to those mega cap companies, especially in tech, which are facing some headwinds.
And we talked about how those headwinds are related to this rotation out of tech and into those cyclical sectors. We also saw how things like political events, the Trump victory, for example, can have a lasting impact on the market.
Right, and then we looked at some specific companies. Dell missed on their revenue and guidance.
Yeah.
Workday and Nordstrom both beat expectations, but still saw their stocks dip.
Yeah, sometimes beating expectations just isn't enough.
And we talked about those semiconductor problems
Mm.
and how any disruption to the supply chain can have huge effects on the industry.
Absolutely.
And then there was that yen carry trade and how the upcoming economic news from Japan could impact markets globally.
Yep, a lot of interconnectedness there.
And then finally, we talked about how core inflation has stopped moderating.
Yeah, which could be a problem for central banks.
Right. So let's bring it all home. What are the big takeaways for our listeners?
Well, first off, you got to look beyond just the indexes.
Right.
The broader market picture can sometimes hide what's really going on with specific companies and sectors.
And speaking of sectors, that rotation out of tech and into cyclicals,
That's a trend to watch for sure.
and political events, who would have thought they could have such a lasting impact on the markets?
Yeah, the Trump victory's still making waves.
Okay, so before we wrap up, I want to leave everyone with one final thought. We know the Fed's trying to get inflation down to 2%, but what if this recent slowdown in inflation moderation isn't temporary? What if it's a sign of a larger global trend?
It's a great question. Could this be the beginning of a whole new chapter in the inflation story? And if so, what does that mean for our investments?
Definitely something to think about. Thanks for joining us for this deep dive into the markets, everybody. We'll catch you next time.